Hi everyone, this is a revision video simply looking at the distribution of income and wealth. Now this is a section of the syllabus, but it's something that you would have looked at in year one. It's very self-explanatory, so do take the time, tune in, listen, just go through. It's very straightforward. There's an additional video on looking at poverty and strategies to reduce poverty, so make sure you also look at that one as well. But we'll start off by looking at, when we look at the distribution of income and wealth, we need to differentiate the difference between income and wealth. So often income will bring about wealth, but sometimes people inherit wealth, and with wealth comes even more income. So have a think, what does the top 1% of all income and wealth look like in the country? If you were in the top 1% of the most wealthiest people in the UK, how much money would they receive in 1 year? Okay, so the top 1% of the country, what do they look like? To be in the top 1% of all income taxpayers, that's about the top 300,000 adults. You would need an income of at least 160,000 a year or more. So that is just short of maybe what the Prime Minister would earn. So if you want to be considered within the top 1% of income earners in the country, you would need to get yourself a job or find your way in a position where you would earn more than 160,000 in 1 year. 236,000 a year is required to be in the top 0.5%. So you can see within that, even half a percentage, there's quite a significant jump there from 160,000 to 236,000. The top 0.1% starts at around 650,000 per year. Now, I don't know what kind of job you would need to be earning that amount of money. We will look at later, that does not necessarily have to come from just a 9-to-5 job. That can come from income from other sources. Typically, when you look at this top 1% of income earners, they are drawn more specifically from London and the Southeast. So you, Beth students, you live in London and you certainly live in the Southeast as well. It is considered one of the more affluent areas of the country. 35% of the top 1% live in London. So that's quite a significant figure. 35% of this top 1% actually live in London. You will know as well as I do, there are some areas of London that do attract very, very wealthy people. London obviously is the capital city as well. So this 1%, where exactly do they get their money from? You might want to make note of this if you want to be within the top 1% one day yourself. Most comes from employment. Okay, so they're engaged in a job of some sort, and that income is coming from their job. About a quarter of income from the top 1% comes from either dividend income or partnership income. Either, for example, they might be a partnership in a law firm, GP, hedge fund managers, etc. Policy choice in the UK that we tax business income more lightly than income generated through employment. So in the UK is a good example of a country that very much so looks after businesses. Corporation tax, or the rate of corporation tax, is much lower than that of income tax. So you're better looked about, or more favorably looked at if you're a business owner than what you would be just the standard person that works a 9-to-5 job and takes a wage for that. So we did talk about earlier about differentiating the difference between income and wealth. So let's have a look at this. Income is what we call a flow of earnings. It's a flow concept, a flow of earnings paid to labor over a period of time. So right now I'm engaged supplying my labor to the school and I get an income from that. The most common source of income is through your earnings. So you can have different sources of incomes, but for most people, for almost all people, the largest source of incomes will be earnings from supplying their labor, going out and doing a 9-to-5 job. A person's income is usually based on the number of hours worked or in the form of an annual salary. Economists often use the term disposable income as the appropriate measure of income. And we know that disposable income is the level of income after the deduction of tax and national insurance payments. So you've got your raw income, and then after that, then once you deduct your income, your taxes from that, you're left then with your disposable income. And it is with that disposable income that you will purchase goods and services. This is used because it represents the amount of money available for spending more accurately than gross income, the individual's income before tax and national insurance payments. What you often will do is on your pay packet later on in life, on the left-hand side will be the gross, on the right-hand side then will be your total income minus all deductions like tax, your pension, your national insurance, student loan, things like that. Therefore, it can be said that the level of disposable income is influenced by the government themselves. So our disposable income, the amount that we have, will be influenced by government because remember, the government set the rates of income tax. Wealth, then, on the other hand, is a stock of assets owned by an individual or organization. So income is a flow concept. Wealth is a stock concept. It's the stock of assets, the quantity, the actual amount of physical assets that you own that are of value to the firm or to yourself. It may take the form of, for example, cash, bank deposits, and ownership of company shares, household goods, such as furniture and appliances, cars and property, for example. So they typically tend to be something physical. Let's say, for example, you have £100 sitting in your bank account. Now, you may not necessarily own a savings account, but if you have chosen not to spend that money, in economics, we would say that that is savings. The individual has decided to save that rather than spend it. But think about any assets in your home, furniture, even regardless of their value, they will carry a value of some sort. Some will be more valuable than others. So if you live in a house full of just ordinary furniture, for example, it would be worth something, but not necessarily a lot. Whereas if you live in a house where there's a lot of antiques, where it's very expensive, for example, you could sell those assets and get money for it. Cars and property being, people often say it's very good to invest in bricks and mortar. Wealth may be obtained through inheritance or through the accumulation of assets over a lifetime. We come into this world with nothing and we will leave with nothing, but we acquire assets during our lifetime. Inheritance, if you think about whenever somebody dies or somebody passes away, they can leave in their will their assets that they obviously can't take with them. So, for example, a large number of people every year get property left to them, they get money left to them whenever somebody passes away, and they inherit those. They haven't worked for them, they haven't bought them, but they have inherited those. Some people can go through their lifetime getting a number of inheritance. Some people can go through their lifetime without ever inheriting anything. It can be converted into cash or may already be in the form of cash. But for assets such as property, it may take time to convert it into cash. So if somebody died and left you their property, you could keep that property and rent it out, and then you can get an income from the rent. On the flip side of that, you could simply sell the property and convert that then into cash. An asset that cannot be turned into cash without loss or delay is known as an illiquid asset. Okay, one that you can't basically convert into cash. The impact of wealth will vary according to the individual's circumstances. So, due to circumstances of birth, some individuals are born into more wealthier backgrounds than others. For some people, not so much the case. Factors that influence the distribution of income and wealth then. An unequal distribution of income leads to inequality and occurs when there are large differences in incomes between inhabitants of a country. We live in a country where there are rich and poor. There is inequality between individuals. Some individuals are much more wealthy than others. In the UK, as with most countries, the distribution of wealth is more unequal than the distribution of income. So we can do things to redistribute income, but we can't, it's more difficult to redistribute wealth because a large percentage of that is inherited. Now, there is a very heavy inheritance tax, roughly sitting at around 40%. But other than increasing that, there's really little you can do that can split that wealth. People on high incomes can devote more of their resources to the accumulation of assets, such as property and stocks and shares. So if you earn a high wage, if you earn a high income, you can acquire more assets, such as property and stocks and shares. There are some people that own stocks and shares in several different companies. There are some people that don't own any shares in any companies. There are people that own hundreds of properties, and there are people that own no property at all. The assets often generate further income and are frequently key influences in causing an increase in the level of inequality in the UK. So what causes this differences? What causes this differences in income? Why are some people earning more income than others? First of all, we look at skills and qualifications. Has a significant impact on wage levels. So your skills qualifications, your A levels, your GCSEs, your university degrees, all the different types of qualifications you will do whenever you go into the workplace, they will have a significant impact on the wage levels. Workers with high levels of skill are likely to be able to secure higher incomes for two reasons. First of all, they generate much greater output for their employers, and so their high marginal revenue productivity, or their MRP, causes their demand for labour subsequently to increase. Okay, so we looked at this when we looked at labour markets. But where a worker has a higher marginal revenue productivity, it means it's more profitable. The worker brings in more revenue if you employ one more worker because they're skilled. They bring a greater value to the organization. Also, fewer workers with high skills are in short supply. A decrease in supply will lead subsequently to higher wages. So if there is a very, very skilled job that's available, not everybody will have the skill set to do that. And so the supply of that type of labor will naturally be low. And if the supply is low, you have to set a high wage rate to attract the right people with the right qualifications into that post. High levels of education. And education is your passport to life. Workers with degrees typically earn significantly more than workers who left school without formal qualifications. So typically we would say that obviously the more educated that you are, the greater the qualifications you will have, and therefore the greater likelihood it would be that you're able to get a job. Educational opportunities can be influenced by a person's family background and wealth. And so education is frequently a factor that causes more inequality. Very wealthy people tend to send their children to private schools. And if you think about it, in some private schools, it could cost up to 30,000 a year to educate a child. Whereas in the state system, every child brings with them roughly about £5,000 from the government to educate them. So in a state school, it costs about £5,000 to educate a child, whereas in a private school they demand fees up to about 30,000 a year. They get more hours, they get more opportunities in some cases, and so people would argue that whilst education is provided in the state sector free of point of access, it does actually lead to inequalities. Conversely, it is often the key factor enabling people to change their social class and move into different levels of income. Go to school, learn well, get your education, get qualifications, and it can lead you into different areas and different social classes later on in life. People often will use their education to get to those greater places. So inequality in levels of wealth. Individuals with high levels of wealth can earn profit if the wealth is in the form of a business, interest if the wealth is in the form of capital, and rent if the wealth is in the form of land. So individuals with high levels of wealth, if you have, for example, if you have a large number, say for example, you've got 10 houses and you rent those houses out, then you've got the rent of 10 houses coming in on top of your normal 9 to 5 job. You are naturally then by default going to be much more wealthier than someone who doesn't own those assets. In addition, these individuals have their labor to offer in return for income. Owners of wealth have the potential to generate much higher levels of income than people who do not possess wealth. So basically, if you have an income, it allows you to buy things that will make you then even further money. Now, household composition and age. We're looking now at the makeup of a particular household. So it depends on the number of dependent children and the number of working adults in a household. This will influence the average income per household. So what we're looking at here is we're basically saying that the factors which will influence your income and wealth will be based upon the number of dependent children that you have. So larger families tend to have less wealth. Families where there are fewer children and therefore fewer dependents will have greater wealth. A household with two working parents and two grown-up children will have a higher average income than a household with one working parent and subsequently five children still in full-time education. So the larger the number of children, the greater the demands there are on the parents to provide for those children. And therefore, any money the parent gets will be spent on bringing up their children. Income tends to rise when a person gains experience in a labor market. So basically, the longer you're in the labor market, the more experienced you become, and therefore that warrants a much higher wage rate. Government policy. So different governments achieve a redistribution in different ways. Now, a redistribution of income and wealth is basically, if you think of Robin Hood, he took money from the rich to give to the poor, to redistribute away from the wealthy and to give to those that basically had nothing. So take from those that have a lot of it and give it to those that don't have anything. Current policy is to encourage workers to seek employment with a higher wage than relying on benefits. So governments try to keep the benefit system low to avoid then money being spent, or it might actually make being on benefits more attractive than actually engaging in full-time work. We wouldn't want to do that. We wouldn't want to create a system where it's more beneficial to be on benefits and be state funded than what it would be to actually go out and do a 9-to-5 job. Not all policies work. Some have negative unintended consequences. For example, inflationary pressure due to rising GDP. So you have to always look at those unintended consequences. All well and good, however, it may lead to this. Other factors that lead to differences, particularly in your income. Discrimination. So we looked at in labour markets, positive versus negative discrimination. Those that are positively discriminated against will receive a higher income. Those that are negatively discriminated against will receive a much lower income than those people doing the same job. So discrimination in the labour market leads to further inequalities. The number of hours worked. If you work more hours, you'll earn more income. So think, for example, part-time workers, workers on 0-hour contracts. They may not be in a position where they can work more hours. The level of entrepreneurship in an economy. And you have to ask yourself the question there, what do governments do to promote entrepreneurship in an economy? If they're doing things like high business tax rates, then that's going to create a disincentive for people to be entrepreneurial and to set up their own businesses. The levels of unemployment. We find ourselves in a situation where there are high levels of unemployment, you tend to get into a situation where there is any jobs that are going will often tend to bring with them a low wage rate. Okay. So more people unemployed, more people on benefits. Benefits obviously brings in a lower rate than if you are employed. Also, the rate of economic growth is another factor. If economic growth is slow, then income levels will be slow and wealth levels will also be slow. Inequality in income then. Since the distribution of wealth arises from the accumulation of assets, individuals or families with high levels of income are more likely to be able to increase their holdings of wealth. So an inequality of income itself will lead to an inequality in wealth. So if there are some people that are earning more than others, those that earn more will be able to acquire even more assets. Therefore, they will widen both the income gap and the wealth gap. It could be argued that income is the key factor influencing the distribution of wealth. So if you had to try and figure out which is more causing a greater unequal distribution, it would be income first because income allows you to acquire assets. It is closely interlinked with time. So you look at the acquisition of assets over a period of time. Inequality of wealth. So, since the ownership of wealth creates many opportunities to generate further incomes, a high level of wealth is likely to lead to even more wealth. So, if you, for example, own a property and you rent out that property, you're then acquiring more income, which will allow you then to buy even more assets, increasing further your wealth. Inheritance and traditions. So, in countries such as the UK, it has been a tradition for the eldest son to inherit an estate. Now, this is almost a bit like a social norm. It's deemed to be the tradition that the eldest son will inherit all the assets. Now, there is less of that happening now than what there has been before. But traditionally in the UK, it was always left to the eldest son because the eldest son would have maintained the family surname. And so the property or assets or the estate would have always have been held within the family name. This tends to maintain the inequality in the distribution of wealth in the UK, as high value estates remain in the hands of the single individuals. So, for example, if an estate where there was maybe, for example, four children, only one of the four children will inherit everything, the other three get nothing. Government policy. Governments have faced problems in their attempts to tax wealth rather than income because a tax on wealth, such as a country estate, might force the owner to sell the estate in order to pay the tax. So there have been slight issues here. If they sell the estate to pay the tax, yes, they earn money to pay the tax, but they have now become very wealthy because they've got a significant boost to their income as a result of selling that. Consequently, wealth tax in Britain is almost entirely based on inheritance tax. So we say that most wealth comes from inheritance, and therefore most of the tax around wealth stems around inheritance tax. This is aimed at restricting the level of wealth that can be passed from one generation to another, and thus serves to redistribute wealth from the rich to the poor. So again, that phrase, the redistribution of income from rich to the poor. Now, the propensity to save. People with high incomes have a greater propensity to save because they can satisfy their wants without needing to spend most of their income. So some people are great savers, some people are great spenders. The ability to save money will influence your income and wealth. If you're able to save, you're able then later on to buy more valuable assets. So, for example, people often will save to buy property to get themselves on the property market. Increased savings will represent an increase in holdings of wealth, thus further increasing inequalities in the distribution of wealth. So that just gives you a whistle-stop tour of some of the factors affecting both income and wealth. So what is meant by the term equity? Equity involves trying to understand and give people what they need to enjoy a full and healthy life. Equity is a normative concept. It's based on a value judgment. Equity means fairness. So what I deem to be fair might be different from what you deem to be fair. Equity is a normative concept and concerns the fairness with which scarce resources are allocated amongst competing ends, based on people's value judgments. So you take a limited stock of resources and you have to distribute that out. Do you give everybody an equal share? That's equality. Equity would be given more to those that need more of it and less to those that don't need it. In its most simplest terms, equity is equal to fairness. People take different views on whether the distribution of income and wealth is considered fair. So what some people deem to be fair might be different from that of others. We tend to believe that inequality is fair if it reflects the greater value of different individuals to the GDP of that country. Equality then, on the other hand, the situation where goods and services are distributed equally. Everyone gets an equal slice of the cake. It is a positive measure of variation in income and wealth because it is measured using factual data on the income and wealth of a country or region. The concepts of equity and equality are important in understanding why governments might intervene if it is considered that inequalities and unfairness generated by market-based solutions are not socially acceptable. So governments will have to look at, do we go down the route of, do we give everyone an equal portion of everything? Or do we redistribute by giving more to the poor and we take away more from the rich, therefore to give to the poor? So one that always does its rounds, I always think this is a really good example to use. On one side, we've got equality. Now, first thing you need to understand in this is the people standing on top of the boxes. They all have different characteristics, and the different characteristics here is height. So you've got somebody on the left-hand side who's very tall. They can see the baseball match without any issues at all. They have that great view altogether. There's no issues with their view. They can see everything. They can see plenty. Really, they don't need that box. But this is equality. Everyone has access to the same type of intervention. The person in the middle, they wouldn't be able to see without it. So they're given support so that they can actually see the outcome being they can see the baseball match. The person on the the right-hand side, they're much smaller than the other two to their left. And they're given a box, the same box as the other two, but that box isn't big enough. They can't see. So if it's left to equality, people have different characteristics. So giving everyone an equal share isn't always the best thing to do. Equity, on the other hand, is basically taking it away from those that don't need it, i.e. the guy on the left-hand side, and giving that to the person who needs it the most so that they all have an equal outcome. So if you look at the equity on the right-hand side, all of them are able to see comfortably at the same level that baseball match. Horizontal equity implies that we give the same treatment to people in an identical situation. For example, if two people earn 15,000, they should both pay the same amount of income tax, e.g. 2,500. Horizontal equity makes sure that we don't have discrimination on the grounds such as race, gender, different types of work, for example. Horizontal equity also requires a tax system which doesn't give preferential treatment to certain individuals or companies. Okay, so horizontal equity, the people on the same income pay the same amount of income tax. Vertical equity is concerned with redistributing income within society. It implies that people with higher incomes should pay more tax. Vertical equity requires proportional or progressive taxes. For example, income tax helps improve vertical equity by taxing according to how much people earn. Horizontal equity is an important starting point for any tax system. And lastly, then, just to finish up, if we look at the costs and benefits of more equal distribution will lead to an alleviation of poverty, as more people have enough income to live above the poverty line, leading to a fairer society which is more inclusive. As people feel a part of society and have enough means for a decent standard of living, less social problems are likely to occur, leading to less crime, a safer environment for all, and greater happiness. This will have to be paid for the taxpayer as higher earners see their incomes redistributed. So it would be impossible for us to live in a society where everyone gets paid exactly the same amount. And think about it, if everyone was to earn the same, you wouldn't get people attracted to those more difficult jobs because they would think, why go through all those years of study when you can earn the same wage doing a job which is more stress-free? Hopefully you find that useful. You can read that alongside your additional notes, but please now watch the video clip that looks at the Lorenz curve and also have a look at the factors affecting or solutions to solving or eradicating poverty in the UK.